and good afternoon, everybody. Thanks for joining us for another Modoras and RJ Sanderson live webinar. Looking forward to discussing the impacts of what looks like a very stimulus-focused post-pandemic budget. Lots of spending, lots of money coming into the economy, and lots of opportunities for all of us. So thank you for joining us today. As Stella just said, thank you for those who sent questions in earlier. Keep an eye out for them. We have built the webinar around many of those. If we haven't, we will address them at the end, and we certainly do look forward to lots of questions as we go. Please send them in as we move along. As you're all aware, for those of you who haven't joined us in the past, welcome. For those of you who have, you will know that we do like to make this very much conversational, break it down in simple terms, and make sure we address things that really impact you as individuals, as families, and business owners, and very much as valued clients of both Modoras and RJ Sanderson. So thanks again for joining us. With no further ado, we'll move on a little bit. If you haven't worked with us in the past, a little bit about our group. We're across 15 locations across the east side of Australia, 200 staff and growing, which is great. But just as importantly, 55,000 clients and growing as well, which is fantastic. We love our clients, we love our family growing. So thank you for everyone for choosing to work with us. One of the reasons we grow, if we could go to the next slide, please, Stella, is a simple fact of why we're in business. Very simply, we're in business to make the difference to your life so that you can experience your full lifestyle potential. To do that, we surround you with professionals. We've been doing this for over 30 years, and we've had great success and great reward along the way with many acknowledgements of how our team and our clients grow together. So thank you, and well done to everybody involved. As always, before we go into the nitty-gritty of today, the disclaimer today is very much general advice. There is no personal advice in what we will be discussing today. Much of what we discuss will have an impact on you. And I can't stress enough, please pick up the phone, email, text, and reach out to one of your Modoras or your RJS professionals, and they can certainly help. And we can make sure that everything we talk about today does become personal for you. Thanks, Stella. I like this first part of the slide. Post-pandemic budget. We know that a lot of the budget is very much focused on stimulus. It's also focused on addressing some areas that need some extra help, some safety, and we'll go through that a bit today as well. But let's get into our fantastic panel who are going to help us digest and dissect what's in here today. So thanks for joining me again today, gentlemen. We have Tony Sarai, Roy Sanderson, and Greg Pease. Tony's the head of our investment committee. Roy is one of our directors from accounting and RJS, and Greg is part of our investment committee and expert economist. So thanks for joining us, gents. I look forward to your insights today, and we'll get started straight away. We'll move straight into the tax implications. Actually, we'll look at the agenda. Today, we're going to be covering tax for individuals, tax for businesses, and superannuation. Of course, they're all very related, as you're aware. There's a lot there to think about for first home buyers. There's some catches there as well, which Roy and Tony will address. Social services and aged care, as I said earlier. There's certainly some areas in our economy that we know needed addressing, and aged care was well and truly one of those in terms of it needed to be fixed up. But there's also some really big impacts for you if you're thinking about having family members entering aged care as well. We'll cover those as we move on. So let's start with our first slide, but tax for individuals. That's all of us. We all pay tax. We all try to avoid it, but that's what we talked to Roy about. Low to medium income tax offset has been extended to June 30 in 2023, which is great. It's also extended the range of what a low to medium income earner is, all the way up to 126,000, which captures a lot of people. The offset will be received by individuals when they lodge their tax return, which is fantastic. Roy, what does this mean for people? What should they be thinking before they come and see you guys this tax season?
Certainly this sort of information or this sort of rebate is going to happen automatically. We don't need to think about it. Our computers are attuned and programmed, so they're going to pick it up. What's interesting is the budget. We already had that in place, already legislated. So the next tax return that we're about to do in the next couple of months, we were going to get the $1,080, and we're going to get it for the following year. So what the budget did is it announced that it's going to be for right up till the 30th of June 2023. So it's an extension of 1 year. I heard Josh Frydenberg interviewed on ABC after the delivery of the budget, and he was asked, why don't we keep this in permanently? And his response was, this was deliberately brought in for COVID, and it will not be a permanent fixture of our tax system. So the $1,080, it's an additional refund on top of what you would normally get. It's putting money into the economy, which is good. We get the extra $1,080. We go and spend it. That's the economy going round and round.
Yeah. Short-term cash injection. I know Greg will cover off this later in fiscal and monetary policy, but so I won't steal your thunder, Greg, but I know it's about injecting money back into the economy to address the government's debt to help us fund the stimuli. So, Tony, individuals getting more money back into their own accounts, things they should be thinking about?
Well, it's a fantastic opportunity. And so there's also other strategies that we can leverage off the back of that, whether it be things like contributions to super, to have a double whammy as such. So there's a number of things that we can look at. But the one thing I'd say is when you do see your accountant and that all comes in place, then obviously sit down and make a time with an advisor to go through what difference we can make with that extra funds that you do get.
Yeah, for a short 3 years. Well done. Okay, thank you. Next slide, please, Stella. This just outlines a bit more exact to what the tax figures or the refunds will be. As Roy's already outlined, this will happen automatically. I think the real opportunity here is talking to professionals about what you can do with it. So did you want to add anything to that, Roy?
Yeah, just thanks, Paul. Just what the sweet spot is, 48,000 to 90,000, you get the full 1,080. That's not per household, it's per person. So you can, two people in the household can get two lots of that. And it phases out if you earn less and phases out if you earn more.
Yeah. Yeah. So certainly some complexity there to talk to you about. Thanks, Roy. Next slide now, they're also giving tax breaks for businesses. Again, a stimulus. It's, they're looking at SMEs who fund lots of Australians and Australian towns and cities. So this is fantastic. Temporary full expensing has also been extended, as has temporary loss carryback has also been extended. So in essence, they've given small businesses a tax break for longer. What should small business owners be talking to you about, Roy?
This is a little piece of gold that I don't think a lot of people have picked up on. We have the ability to go out and buy equipment that we need. Never waste money to get a tax deduction because you only save the tax rate that you're on. But here's the gold. If you have equipment you need and you go out and buy that before June 30, then you may create a loss which allows you to claim back tax you actually paid to the tax office last year. Now, that might sound a little convoluted. How do we work that out? The message is between now and June 30, get some tax planning. What eventuated in the budget was that they're extending this full write-off through to 30th of June 2022. So if you can't get a delivery of something like a piece of equipment, machinery at the moment, like earth digging machinery, you won't get delivery before 30th of June. But at least you can plan it for the following year now. And I think tax planning is crucial.
Yeah. Can I extend on that a bit, Roy? You and I speak about this a lot when we're talking about businesses. I think your first point was really important. Don't waste a tax credit just to get something you don't need. So not only should this slide here or these points become part of your tax plan, but they should, in essence, become part of your business plan with your accountants as well.
Yes, totally. Yeah. Setting your goals, your business plan and setting your goals for a business. And also we roll that into personal as well.
Correct. So cash flow forecasting, making sure you're in the right spot, not just for a tax deduction.
Yeah. Now, accountants often get criticised for not being proactive. Bear in mind, we tend to work with the clients who are most proactive. If you're sitting back listening to this and you're thinking, should I or shouldn't I get tax planning advice? The answer, if you're in business, the answer is yes. It's going to be valuable. So get on the phone, get an email off to your accountant so you get something, a meeting or a review of where you stand before June 30.
Yeah, absolutely. Individuals can benefit from that too as well, and particularly wrapping individual wealth with their accountants.
They can, because we'll see some slides soon about superannuation. And if you're an individual and you want to save some tax, there's some great I think one of the other pieces of gold out of this presentation and out of the budget will come up a little bit later.
Yeah, great. I think the next slide is everyone's going to be a little bit excited about wage subsidies. The government will provide 50% of the wage bill for 12 months for employers hiring new apprentices. I think that's fantastic. There's lots of opportunity for businesses to grow and people to receive new skills. The subsidy is available to businesses in group training and a number of places uncapped, which I think is great. Small businesses need to do anything in particular around that? I think this sits with business planning as well, because another opportunity to grow with 50% of your wage bill.
Oh, it's a terrific incentive. The fact that they've extended it is good. And it's a way that businesses can gear up a little bit, and it's an encouragement to put on more apprentices at half the price. And by the time you've got half your wage paid, you've got the apprentice coming out a little bit, a year later, knowing a little bit more about the job. So you're being compensated for the pain of training somebody.
Yeah. The chance to grow, as we all know, cash flow is king in SMEs, and your biggest bill is on, obviously, your wages. Or
correct.
Generally, your wages. Yeah. Okay, so great incentive to talk to your advisors about that as well. Okay, superannuation. There's been lots of changes here. It can be a complex place to look at anyway, but there's been some change, all beneficial. But they do transfer over time, and it does really matter where you are in your working life, in your life stage as well. Tony, did you want to go over a couple of the key points we should be looking at here?
Yeah, so in relation to superannuation, there are a few changes, and some of these changes were as part of the last budget. So you will see that these actually come through on the 1st of July this year. So different things for different people to be aware of. Transfer balance cap. So if you've got over firstly, it was 1.6 million. That's increased to 1.7 million as of the 1st of July this year. Concessional contributions cap has increased. It will increase from the 1st of July from $25,000 to $27,500. That's inclusive of what your employer puts into superannuation for yourself as well. The non-concessional contributions cap has increased from $100,000 to $110,000, and for 3 years that's then projected out for the $330,000. And then you've got some other numbers there for the low rate cap in terms of what you can take out: $225,000, 1.6 for the untaxed plan cap. An important note, especially for retirees in pension phase, from the 1st of July this year, the account-based pension payments will return to their default payment levels. So if you're over the age of 65 and between 65 and 70, you had an account-based pension, you had $100,000 in, let's say, in pension phase, you could reduce the amount that you take out by 50%, so from 5% to 2.5%. That 2.5% will go back to 5%. So that's something to be aware of. The superannuation guarantee will go to 10% as of the 1st of July, and maximum super contribution base $58,000 per quarter. And the government co-contribution, if you put in $500, you'll get $1,000 if you are under $41,000, and that tapers out when you get to $56,000.
Yeah, thanks, Tony.
Can I ask Tony a question while we're on this slide?
Yep.
Without notice, they're all without notice. The second line is concessional contributions cap. The word concessional for Joe Blow, not in the industry, means tax deductible. Tony, it's currently today 25,000, but there's also a carry forward. If last year, and I know this wasn't part of the budget, but I thought I'd mention it because it's what I call a piece of gold. It was announced previously, but it's important. If last year you only contributed 20,000, you carried forward the 5, and you can contribute that extra 5 this year before June 30. Is that correct?
That is correct. And the other little bit of gold there is to seek advice, quite simply because you may say, well, okay, if my income is going to increase further next year, whether I don't do that 5 now and I'll have that extra amount to be able to put in for next year. So it does become important to actually pick and choose your timing of when you do use the carry forward rules. So that is something absolutely you're spot on the money there. But it is also worthwhile speaking to your accountant and your advisor to say, well, okay, when do I actually put that in place?
And they carry forward for up to 5 years, if I remember correctly.
5 years, correct. Yeah, 5 years. That has not changed. Yep.
Terrific. Thanks.
Thanks, gents. You're right. Yeah, superannuation can be a bit of a minefield. The next slide addresses that even a bit further. Some change here that anybody that is planning their exit from the workforce or retirement or in retirement and looking to thrive beyond, there's some great changes here, Tone. Some
There
great,
is. There is.
yeah.
And so the work test no longer applies. So if you're over the age of 60, well, as it says here, the work test no longer applies to Australians between 67 and 74. Whereas beforehand, you had to meet the work test. You had to do 40 hours within 30 days to be able to contribute to super. That is no longer applicable. Now, that does go with when making non-concessional contributions. So that's money that you've already been taxed on that goes into superannuation, or salary sacrifice contributions. It is not for personal deductible contributions. So that's just something to be aware of there.
So, Tony, there's quite, sorry to interrupt you, mate, quite a bit of technicality there. Just to break it down, who would be really be very interested in this at the moment? How would you describe the people sitting at home that are looking for this at the moment? Is it self-employed? Is it PAYG? Is it people at 50s? How would you start to say, because there was a lot of movement through that statement, and they're all very relevant, but who's it really going to be saying you should be sitting up, listening, and seeking advice?
Look, this impacts. Certainly, if you're in that age bracket, that's one. There's another one, which is the next point in terms of if you, in terms of downsize of contribution, but that's been extended as well. But this would impact anyone that is that has money, cash available to contribute to superannuation. So that's after tax money.
Yeah.
And you sit between those ages, 67 and 74. And secondly, that this will be in relation to anyone that's still working or in the workforce that wants to contribute. Now, please note that this is as of the 1st of July 2022, so it doesn't come in as of the next month. So it is from the 1st July 2022.
Yeah, perfect. Okay. Downsize of contributions. This is another change for people looking for tree change, seed change, add more to their superannuation. It's been around for a few years, but it's been moved down to 60 now, which is also great.
I've got a number of clients that have used this, and certainly it is worthwhile. And currently, and Roy will certainly be able to talk about house prices, especially in Victoria. I can talk about house prices here in Queensland that have gone through the roof. But if you are looking to make that change and downsize, then you can contribute up to $300,000 per person when you sell your family home and contribute that to superannuation.
Yeah, it can be a great strategy.
It's terrific when you're assessing life goals.
Absolutely.
Yeah, absolutely.
And on that final point there, income threshold for super guarantee, the minimum has been removed. So the current minimum income that you have to earn before anyone makes a contribution to super for you is $450 per month. They have removed that minimum. The government is expecting an additional 300,000 individuals to now receive SG contributions. Now, one of the reasons why they did this was the fact that 2/3 of the workers out there in that bracket are female. So this was a push to say, well, okay, let's try and equalize that superannuation balance for females. How can we do that? Let's remove the minimum cap of $450 and so on. So they've done that, and that will assist young workers, especially people that are full-time university students with this out there working and earning that extra dollars.
Yeah, absolutely. It's a good start to closing the gap, which we all have to do more for. So well done. Thanks, Tone. The final one for superannuation is relaxing some residency requirements. Tongue twister there for the start of the day. This is more for those for self-managed super fund. There's there's not a large amount of our client base this really applies to, but it's certainly something to be very aware of, Tone.
Yeah, and we do have the odd query that comes through in terms of, oh, look, I'm looking to go overseas. How does that impact my self-managed super fund? The years have changed from 2 to 5. The one thing that I will say is seek advice in relation to this, because this is extremely important, because if you get this wrong, it can cost you a significant amount of money as part of the ATO. So speak to your accountant, speak to your advisor, because whether you're going over to as a temporary move or it happens to be a permanent move, that will have a significant impact to your self-managed super fund.
Yeah. So I think we'll agree. The last three slides show that the government really wants us to start to save for our own retirement, which is, I think we all agree that's a good thing. So removing some of the paperwork or red tape for that's great. Okay, first home buyers are the next winners. New home guarantee, further 10,000 places will be granted under the new home guarantee from 21 to 22. Specifically for first home buyers seeking to build a new home or purchase a newly built home with a deposit as little as 5%. The next one covers a really small deposit as well. Family home guarantee for single parents, helping those in need or some of the vulnerable families in Australia, which I think is a fantastic idea. Guarantees will be made available over 4 years to eligible single parents with a deposit as little as 2%, subject to ability to service the loan. And then the final one, a super saver scheme with the amounts increased from $30,000 to $50,000 who have access to get into your own home. Now, before the webinar that the panelists and I discussed this, there is some specific technicalities with all of these, and they're not always the golden gift horse that they look, are they, Roy? There's some
No, they're not. And I feel a little bit passionate about this area. The fact that the government have said they will guarantee 18% of a loan and you've only need a 2% deposit, what they're really doing is saying to the bank, do not charge lenders mortgage insurance, which is quite expensive. So there's a saving there. But in this situation, you will have a single parent who's going to be borrowing 98% of the purchase price. It's not a loan from the government. It's not a gift or a grant. It's purely guaranteeing part of the loan you've taken out from the bank. And I understand interest rates are very low, but if you have a sole parent with a couple of children who go out and borrow $450,000, $480,000, when interest rates go up, which we know won't happen until 2024, we believe won't happen until 2024, or if they have a drop in income because of some circumstances, that's going to put a single parent in a very, very difficult position. So I think you need to be balancing checks. Have you got supportive parents? If the wheels fall off your job, what happens if interest rates? You really need to make sure you're getting into this for the right reason and you've got some safety net if something goes wrong. Because I'm nervous about anybody who borrows 98% or even a first home buyer who's buying a new home, the 95%. It scares me a little bit. I think these are trying to be nice to first home buyers and single parents. It is having the effect of motivating the property market, which doesn't need motivation. It's travelling pretty well. I don't think these are all that well founded, in my opinion. It makes me nervous.
Yeah, good points. It's certainly something to be well aware of before you jump into debt. And Tony, similar with super, there's quite a substantial jump from 30 to 50K, taking 20 extra K out of your super. I know there's some parameters around that you'll talk about.
Yeah, I just wrote some notes beforehand. And under the rules, an eligible person can only apply to have a maximum of $15,000 of their voluntary contributions from any one financial year included in the amount that may be released. So therefore, a member would need to make voluntary contributions of up to $15,000 over 2 financial years to take advantage of that scheme. But the government has not announced that it intends to increase the $15,000 annual voluntary contribution limit. So therefore, a member would need to contribute over 4 plus years to take advantage of the scheme. So it's not all that it seems. I think, I won't say it's smoke and mirrors, but there's something there. However, as Roy said earlier, I'm a little bit nervous about that as well. And I don't think that will really impact a significant amount of people in relation to the super scheme there.
Tony, as I understand it from our client base, very few people, in fact, I'm not aware of any clients that have taken this scheme up. Is it a popular or unpopular scheme?
No, I can, in the last 12 months, across our 9 advisors, across our multiple locations, I do not know of one.
There you go. I don't think it's a popular scheme.
So, yeah. Guys, just before we jump off first home buyers, there was this Anne sending a question regarding super. Does super income threshold being removed apply for juniors?
Yeah, it's that $450 threshold. So that $450 threshold has been removed. So if you've got 15-year-old or a 16-year-old working at Macca's that's only getting that one shift a week or one shift a month, they will now have to be paid superannuation.
Great. That's a good thing. Good thing. There you go, Ant. Thanks, guys. We'll move on to social securities now. So this is the area of the budget that has started to address other parts of our economy. Childcare, one we all know has needed some assistance for a long time. Increase to the rate of childcare subsidy by 30% or 30 percentage points for the second child and subsequent children aged 5 years and under in care to a maximum rate of 95%. Removal of the childcare annual cap, which is a rate of 10K per child. So this will provide great choice of parents who do actually want to work that extra 1 or 2 days a week, so giving more flexibility. And as Tony started to allude to earlier, predominantly aimed at females in the workforce, which is an area that will help build super, will help build income, and help set people up for the future. Pension loan schemes, increased flexibility effective from July 22. A voluntary reverse mortgage type loan currently available through Service Australia allows fortnightly loan of up to 150% of the maximum rate of the age pension. No negative equity guarantee will be introduced, so borrowers or their estate will not have to repay more than the market value of the property. So again, protecting those in a vulnerable time against the traditional reverse mortgages with banks. And eligible people will be able to receive 1 or 2 lump sum advance payments totaling 50% of the maximum age pension each year. Based on the current age pension rate, this is around 12 grand for singles and around $18,000 for couples. For those in retirement and have the ability to access the equity and want to do more, it's a great little scheme. It's something that should never be approached without further advice, because it does, as it alludes to in that slide there, have knock-on effects to your estate as well. So it's something that should be very carefully considered. Tone or Roy, did you want to add anything to those 2 points?
Oh, yeah, just very quickly, I'll throw in the fact that once again, I don't think it's a very popular scheme, and I would treat it at arm's length. Very rarely would I come across a client that a client would even mention this. For me, I don't think. I don't think it's really. There'll be a lot of uptake with that from our clients. Roy, would you agree with that?
Yep, 100%. I don't think there'll be much uptake at all.
Yeah, I'll be suggesting if people's parents start talking about it to reach out. If our client base have parents in that age group, my experience is that's where it comes from generally.
Yep. I might just add the top part of the slide, childcare. We've just had asked the question: what if you've got one child? This relates to the second or more children, so it doesn't affect you if you've got one child.
Tony, you can go and have a couple more.
I was going to say the oldest child always misses out. Is that right, Paul?
We always do, mate. We always do. Okay, thank you. Next slide. We're continuing with social services. Some support for the unemployed, which is also fantastic. An increase of $50 per fortnight to the base rate of working age payments. The income-free threshold for certain working age payments has been increased by $150 per fortnight, and face-to-face servicing for job seekers has recommenced, implementing a graduate return to job search requirements for the 15 months until July 21. So again, all about helping the economy, easing people back into the workforce and helping those that have been most vulnerable during some downturn time. So I know, again, Greg will address this, but that certainly does affect the rest of the economy. Aged care is our next slide. This is something that I do want to talk a little bit more about, Tone. For those of you who are unaware, aged care in this budget has been addressed because it was a failing service. We're well aware of what happened in the Royal Commission. Everyone knows that money, infrastructure, and people have needed to be thrown at this. So it's nice to see they've started to address that. There maybe need more done on that. For today's discussion, this does have an impact on those who may need to take advantage of aged care in the future or have elderly parents. It can be a minefield. It really is quite a daunting task, both emotionally but financially. So to address it, what we've talked about here, 80,000 additional home care packages over the next 2 years, introducing new star rating to allow aged care recipients and their families to compare providers. So again, talking about safety. A new funding model, that's something that will need more reflection, and I would be certainly reaching out to your advice professionals to discuss that further. Increase in the government's basic daily fee supplement. Again, that does have an impact when you're starting to look for providers. From early 22, increased funding to improve access to respite care and support through the government's care gateway, which is great. Aged care workforce will receive funding, which will include upskilling the existing workforce and providing training for thousands of new aged care workers, and establishing a new governance and advisory structure. These proposed reforms of the aged care system in response to the Royal Commission. So, as I said in our opening or introduction to this slide, a lot of this is to focus on really improving a system or an area of our health services that need it, but it does have knock-on effect to our financial situations. Tony, have you got any insights that people should be thinking about?
Yeah.
If they're facing this?
Look, it's a very complex area. So,
it really is, yeah.
And from an advice perspective, it's something that I would strongly suggest that if you're heading down that path or your parents are heading down that path, to certainly seek advice. The government has thrown, I'll say, billions as part of this budget in relation to aged care. They're providing incentives for nurses to stay longer. So the longer you've been there, there's incentives there as well. They're providing more dollars for, as you mentioned, in terms of respite and home care. They realised that there was failings around, as you mentioned, failings around this as part of the Royal Commission, and that this is something that they need to spend a lot of money on and a lot of care on. And I think this will be the start of what we see over the next number of years.
Yeah, great, because it can cost homes if it's done well.
Absolutely. It's a very complex area, and it can be very costly if not done in the right way.
Correct. Okay, thanks, guys. Let's move on let's have a snapshot. What are the key initiatives? What are we seeing coming? Let's put some numbers around what we've spoken about just to wrap up before we've introduced Greg again and start to digest a bit about the economy. Let's look at the big numbers. Business investment incentives of $20 billion, which is great. We're a country of SMEs predominantly, or small and medium enterprise. So it's great to see that there's money going there, as you just spoke about. $17 billion into aged care, $15 billion into infrastructure, $7.8 billion into low and middle income earners, $1.7 billion into childcare, and 20,000 new places. As we opened with Greg, you'd agree that these are the numbers that add stimuli. This is where the economy gets the fire lit.
Yeah, 100%, Paul. We agree with that. Just rolls off the tongue, doesn't it? A billion here, billion there. But,
it'd be nice.
As Tony said, let's say a couple of billion, $17 billion into aged care. That is a massive amount of money. So you're 100% right. When we look at the size of the fiscal spending for the economy, this is a really big boost. And look, it is going everywhere. Like even on the bottom left around the low and middle income tax relief, $7.8 billion. That's a lot of money. And I find when we talk to a lot of our clients over the past year, a lot of people are, they see that the economy is doing really well and they're kind of confused. We're in COVID, we've got all this bad stuff happening. How's the economy doing really well? And really the size of the fiscal deficit is critical to that.
Yeah, and mate, we'll get into those in coming slides. Before we dig into that, a quick snapshot of who are the winners from the federal budget. In very broad terms, families with more than one child, as Roy just pointed out, residents in aged care facilities, first home buyers, construction and engineering firms, and single parents. I would add to that anybody working or building businesses in our economy. You agree, Greg? What's the feel of the business owners that you talk to?
Yeah, I think. Look, if you look at anything from listed companies through to business owners, economic conditions are really tight. So really, really good to be a business owner at this point in time. Usually when we do have these slides for the federal budget, we have, winners and losers. We probably only have one slide around winners this year because it is an extremely expansionist kind of policy. Probably the losers, if we were, to come up with one, was I guess being out of the market or not owning the businesses or anything like that to kind of profit from this amount of money that will go through the economy.
So similar to what we spoke with Roy about, do you see this as there's certainly a chance to start thinking, start planning, get your ducks in a row and start to take advantage of what is going to be a growth period or a supported growth period?
Yeah, definitely. I mean, and I think the government have said that as well.
Okay.
That if you think about policy response, is that, what this shows is that the federal government is well and truly willing to keep fiscal policy up to support the economy. Really, when you look at policy, you have fiscal policy and monetary policy. Monetary policy means interest rates, and as Roy kind of pointed out, they are extremely low at the moment. So there's not a move that the RBA can make with monetary policy. And so it's really good to see that the federal government's stepping up with fiscal policy, because the thing that we do know from COVID is that gets straight into the pockets of savers, but also spenders, and actually stimulates the economy.
And just on that, Greg, I think it's important to also note that the government's also realised that rather than handing individuals large lumps of cash, or certainly a significant amount of cash that they can go spend, that they realise that businesses create jobs. And so as a result, what can they do for business to create more jobs? Because you're not looking for that just small sugar hit, you're looking for that long-term growth as well.
Yeah, definitely. I'd agree with that. Yep.
Which leads us to our next slide. You spoke about your fiscal policy. Some of the thank you, very gone to it. Thank you. I was looking at the wrong screen. Sorry. So you talked about the fiscal policy, and one of the big things that some commentators are talking about or bringing to people's attention is our debt, and this slide covers it here. Our debt burden versus our federal budget. What is this really telling us, mate? And what do you see optimistic, or is there any concerns without increasing debt?
Yeah, so I mean, if you have a look at the chart on the left, the debt burden is increasing. But when you have a look at it over the past 100 years and take a really long-term view, it's actually not that high.
Yeah.
So I think you'll see a little bit from the opposition saying about debt levels, but we think that's unlikely to kind of hold the government back anytime soon. And then you can see on the right the level of fiscal the deficit. I mean, the deficit that they ran last year and also this year is really big, even in terms of a 50-year context. So that is what, I think the key thing to take away is that the government really is supporting the economy.
And the other thing I'll throw in there is what's the opportunity cost? And, so if we don't have that spend, can we afford not to? And the other thing to take into account is if you're going to go borrow a bucket load of money, best to do it at the lowest interest rates that are around and spend on infrastructure as opposed to not doing it at all. So it's certainly, from an economic point of view, better that they're doing this now than doing it when interest rates are higher, where it's unaffordable, or not doing it at all.
Yeah, I agree with that, Tony.
You agree with that, Greg?
And if you flick over to the next slide, I think the flip side of that, when you actually have a look at the budget deficit, if you can remember, the budget last year was in October, and you can see on the left-hand chart, 536 was forecast to be that was the kind of October budget. That actually came in at only 407. You can see that kind of grey bar was actually where it came in. So what the government basically has done is throw another $100 billion of additional spending. And you can the chart on the right being 503. So actually what this tells us is that economic conditions are actually better. The budget was a lot better than actually the government even thought, even in October or the mid-year estimates as well. So, companies are in extremely strong conditions. Taxes are up, and the government just feels they can spend more money, as Tony kind of alluded to. We think it's a really good outcome for the economy.
Well, I love the next slide, Greg, that shows, from 2019 to now, this really demonstrates the amount of money that we're pumping into our own economy. Yeah,
that's right. I mean, that's the purpose of the slide, just to say that, it is a massive amount of stimulus. So don't expect that this is, this is not an insignificant amount. This is market moving and just economy repairing type budgets. You're 100% right. When you look at, where the budget was in, pre-COVID 2019, and if you can remember at the time, there was a lot of debate around, that's a big budget deficit. That's well and truly out the window now. And they've thrown out the old rule book. And I do feel that the government feels they've got a lot more ability to fiscally stimulate the economy, and they're going to use it.
Yeah, and it's benefiting us all. Thanks, Greg. Tony, did you have anything to add to that? As for investors, what are you seeing opportunities for investors with this type of stimulus? What are people doing with their money now? What are they starting to think about? Is there opportunities for people to go, I can grow with this? Our economy's grown. Where's the chance for individuals and businesses to grow? I'll come to you for businesses, Roy. But
the one thing that we're finding is that certainly with the low rates of interest, so we are having a lot of clients saying, well, okay, what do I do with the money that I've accumulated? So I'll use it, and Roy is best to speak about Victoria, but I mean, if you're in Victoria and you've spent 17 weeks in isolation down there, you can't even go out for a cup of coffee or go out for dinner. You've saved money in the last 12 months. So there have been people that have saved that money. They are looking to do something with it. Some people are using it for lifestyle, so they're moving homes and moving from city areas to more country areas or a warmer climate, heading up north, or whether it be just lifestyle things. I'll buy that new TV. I'll go. I'll buy that second screen for my computer, quite simply for the fact that I'll be working more at home and those sorts of things. And Greg will be able to touch on this, and we spoke about this off screen. But companies like JB Hi-Fi that have done extremely well over the last 12 months, purely based on that. So we are seeing clients looking to invest more, which is fantastic, and at the same time, because you're not getting the returns in cash, and you're not, as Greg mentioned and Roy did earlier as well, you're not likely to over the next 2 years. Cash rates are not going to increase. That'll be the last thing that the banks increase. The banks will increase they'll certainly increase their home loan rates in 2 years' time, but the cash rate will certainly be the last thing that they increase.
A good time to invest. Roy, what are you seeing business owners doing? This has to be a good time to invest in your own business as well.
It probably is a good time to invest in your own business. A couple of things that affects businesses and individuals. We've noticed we're doing a fair bit of mentoring at the moment through VECI, which is Victorian Chamber of Commerce and Industry, a Victorian initiative. And in these mentoring sessions, we are finding that when we look at a business client's home loan statements, their variable rate that they're paying is actually higher than the fixed rates on offer over a 2 to 4 or 5 year period. So almost in every occasion, we've asked the client if they're going to stay in the home, then fix either all or a portion of the debt. You can't pay it off while it's fixed, or you shouldn't. So that's a conversation. Think about fixing your interest rates. The talk about people shifting out of Victoria or Metro, Shepparton last year, which is country Victoria, had a 55% increase in house prices. And there is a flood of people saying, I don't need to work in the city anymore. I don't need to live within a close radius. I can shift out to a country. That's why the country Victorian areas are going through the roof. But I have a question, more for you, Greg, again, without notice. But I picked up last night that the government have based a lot of the future on an iron ore price, which is making the government a lot of money. On memory, I think it was either 55 or 58 US dollars. But the average, that's like a 5 year average, but it's rarely been at that level, and currently trading on memory up around 200, 180 US dollars. Now, if they've got this forecast wrong and iron ore stays at, let's say, $100, is that going to create a lot more income for the government in the next 2 or 3 years? Have they been too conservative in their estimates of income in the future?
Yeah, you're 100% right. So if we have a look at the iron ore price at the moment, it's around $220 a tonne. And you're 100% right. The estimates are based on $55 a tonne. Look, we look at a lot of analysts' expectations for that iron ore price, and that's particularly the case for, it impacts Rio Tinto, BHP, Fortescue, a lot of our miners. It also impacts the Aussie dollar. But probably across the board, I would say the $55 is a very conservative estimate. But we do think that iron ore is extremely high at the moment. I think every broker, every analyst in the market would think that and expect it to go down. You're 100% right, Roy. If it doesn't, what does that mean? It means the budget will be in a far better position than it actually, than they're estimating here because of the amount of, taxes they would have received off iron ore. And just to understand iron ore, it is the biggest, and it dwarfs every other kind of export that Australia has. It is, we're not a banana republic in Australia, but it is the number one by a long way. So it's a really good call out. I'm just mindful of time.
Okay, move on, Greg.
Yeah, we wanted to finish it at 1:20. Maybe if we could just go through just 2 slides time, and I'll just finish on some of the key data. Let's go through this. Next one. Yep, just this, and I'm happy to just finish on this because it just reiterates the point that I think Tony just made. Do not expect, if you're sitting on term deposits and maybe a couple of years ago you got 2%, and you kind of realise that your term deposits are really low now. You can see the RBA's expectation is not to be lifting that RBA cash rate through to December 2023. So don't expect, if you've got investments in cash or you hold a lot of cash, just don't expect that term deposit rate to trend up anytime soon. If you have fixed interest investments, so bonds, you can see that the bond rate is expected to kind of rise. And so it is rising every month at the moment. You do need to be really selective on the bonds that you actually buy. One of the things to understand about bonds is when interest rates rise, while that's good if you're holding those bonds to maturity, in the short term, that can cause, as bond interest rates rise, capital values can fall. So we just think you need to be really selective about what bond managers you're invested in, and the duration of those bonds, which just means the length of those bonds. So they're probably the key kind of 2 takeaways from, I guess, financial markets. As I said, I think the size of the fiscal stimulus is very stimulatory for, equities and, as Roy said, property. So most growth assets have got a very good backdrop, but just be careful on the defensive side. Yeah.
Look, I think what it highlights is speak to a couple of professionals, your accountants and your wealth advisor, and have a full scale view. Don't just think, get my home loan sorted, get my tax sorted, get my wealth sorted. Talk to a full scale advisors and make sure you're looking at all, because the opportunities are wide and deep, which is fantastic. So thank you for pushing through that, gents. We've given us plenty of time to answer some questions. So ladies and gentlemen on the end of the Zoom, please feel free to reach out on the chat line. I'll address a few of the questions that we've got submitted prior. We've gone through most of them, but there's some really good ones here. Greg, I'll start with you. What's your forecast on retail within the next 2 to 3 years?
Yeah, so it changes daily. The big thing out of the budget is going to be the tax cuts to the low and middle income, and that's kind of $7 billion. And so if you think about what happened with COVID and JobKeeper and the amount of stimulus that went in from the federal government, that led directly into retail, and JB Hi-Fi and all those kind of listed companies just did extremely well. We think that particular measure of the budget will, that'll end up in the same place as well. So we think retail will be strong. Also, when we listen to the government and the RBA and what they're kind of talking about, there was a lot of talk maybe a year ago about a fiscal cliff, or are we going to get an L-shaped recovery where it will go down and it won't recover? And we certainly don't think that. We think, a lot of that money, it does get spent, and we think retail will be extremely strong going forward. Yeah.
Okay, fantastic. I've just got a question here regarding wages. I saw in some of the research you provided earlier, Greg, the assumptions around this, but the question is basically, what about wages? Are they likely to remain flat for the foreseeable future? I know the government's made some assumptions. What's your view?
Yeah, so if you have a look at what the government is saying, what the RBA is saying, they are expecting it to be flat. So wages is really important because it's probably, I think Tony mentioned it, or maybe Roy before, it's the biggest thing that feeds into inflation. And so if you do get wage growth, because at the moment you are seeing a really tight market, you're seeing actually commodities go up. And so you are seeing really tight supply chains. The worry is if that gets into wages, and if it does get into wages, that can then feed into inflation. If it feeds into inflation, then the RBA might have to do something. We're not that particularly worried about wages. We're quite confident that there's a little bit of wage kind of slack in the economy. We don't think that'll take off and cause inflation or anything particularly to worry about at the moment.
Okay, thanks, mate. I love this next question because it sounds like something that we hear all the time in the back of a taxi or down the pub or somewhere. Where's all the smart money going? That's an opening question. I might rephrase that. What are the smart investors doing?
Can I have it? Can I have a shot first?
Everyone's first shot. Okay.
No, I have first shot.
We've all heard that. We've all heard that. And it's such an open question.
Yeah, but this is more of a warning. Greg will answer it properly. I can tell you one thing. There is a non-bank lender in Victoria, and I don't know if they're interstate, and I'm not going to name it, wouldn't be right, but there's hundreds and hundreds of clients listening to this, and this is a word of warning. Don't always chase the biggest interest rate return. They're advertising 4.5% on your money, but if you go to their website, they're lending loans out to money out for loans to buy houses at 1.9%. So they're getting money in at 4.5% and lending it out at under 2%. Now, tell me if that is not a recipe for disaster. So when you are going to go and invest money, don't just look for the highest interest rate. Speak to an advisor about making sure it's somewhere safe. Because 4.5% doesn't sound logical. That's where the smart money should not be going. Sorry, Greg, you can maybe answer it better than me.
Yeah, no, I agree with that, Roy. I mean, ultimately what you see with a lot of those things, and it happened through the GFC with a couple of really well-known products that went under, is there's a liquidity mismatch. And they do tend to take on a little bit more credit risk. So what you will find if you dig into that, I'm not sure of that particular one and if they are lending at a lower rate, but sometimes they're lending to property developers and mezzanine finance and things like that at higher interest rates. And we've just seen the collapse of Mayfair, which was doing that particular thing and, buying assets like Dunk Island, so it is a recipe. Always, as soon as there's a little bit of a rush for liquidity, those players tend to go under. So, yeah, I think that's really good advice.
Yeah. What that screams to me is that there's a lot of complexities in investing. It's a lot more than just one area. Tony, did you have anything to add to that?
Look, the one thing that I'd say is the only reason why you look to invest is three reasons. Number one, you're looking for growth. Number two, you're looking for income. Or number three, you're looking for a combination of those three things, those two things. And so where's the smart money going? The smart money goes depending on what you're looking for. And so if you're looking for growth, there are places where you can invest and you will get growth. Even in the current environment, and if growth was to slow down, you would still be able to get growth out of those companies. Income, same scenario. There's companies out there that have got fantastic businesses where they provide a fantastic income, and they're resilient businesses through all cycles that you can invest in as well. So where's the smart money going? It depends on what you're looking for.
Can I summarise everything that you've all said? The smart money is going to somewhere that's documented, that's researched, that's based on facts, and is strategic. It's not reactive, and it's not quick win.
The other thing I would just add quickly, Paul, is that we're in an environment where a rising tide lifts all boats.
Correct.
And at some points in the cycle, like last year, we are 100% around you need to buy the highest quality businesses in the market, and the smart money has to go there. Because when you're in a really tough investment environment where businesses are competing, you need to have the best businesses that will compete really well. In the current type of environment, I would say a lot of small businesses, if you're a builder or anything, is going to do particularly kind of well. So I don't think you need to be extremely kind of discerning about the quality of the business at this point in time. I think it probably is a period where the rising tide does lift all boats.
Yeah, great. Okay, guys, we'll move on to the next one. There's three grouped here, predominantly all about small businesses, and I'll summarise all three. What are the advantages for small businesses or opportunities that exist for small businesses post this budget? I think we've covered quite a few, but is there anything you'd like to scream out? I think it's certainly about planning.
I'd probably reinforce tax planning. Yeah, carry back rules for small business, immediate tax deductions for assets that you need, allowing you to get a tax refund of tax you paid last year. That's an opportunity. We've covered a lot. Extra money into super. I think it's all about doing some tax planning before June 30.
Mm-hmm.
Yep.
I would agree with that. The other thing I did have in one of the slides is just the quantum of that gold. If the fully expensing is gold, that's $20.7 billion of gold. Like that is a really, really big package. That's not a kind of small thing. So I would agree 100% with Roy.
Yeah, great. Changing gears a little bit here, guys. What do you think the impact of the budget will have on the equity market and the property market in Australia, or for the next 12 to 18 months? Again, I think we've covered that.
We've covered that.
Yeah, I'll cover that quickly but just rehash. At the end of the day, this is a very stimulative budget. The more stimulative, the better that tends to be for equity markets and property markets, because you're going to get a really strong economy. So all else being equal, that's going to be really strong for the economy. The only thing I would say is, with financial markets, then you can't just simplify it down to one factor being the budget. There's a lot of risks. There's a lot of, things that are always kind of changing in the economy. But all things being equal, the budget will definitely push growth assets forward.
Yeah, great. Anything in particular for a sole trader? Is JobKeeper payments received considered an income for the sole trader, Roy?
Say that again, Paul. Is
JobKeeper payments received by a sole trader considered income?
Yes, it is.
Yeah,
you pay tax. It's taxable income. You pay tax on it.
Yeah, great. Here's one for you, Tony. Quick one. What shares should I be selling?
Go speak to your advisor. There is far too much information that we'd require to say, why are you selling? What are you looking to do? In the very limited time that we've got, and I know that we've run over time, but speak to your advisor. Your advisor would be able to have that quality conversation with you.
Yeah, and it goes back to: are you looking at income? Are you looking at growth? What are your goals?
Yeah, and there's quite a few here about what I should buy, what I should sell. So I think we've addressed that. Yep. Guys, I know we've hit time. I'll just go around the grounds. Greg, any last messages that you like for everyone online today?
No, not really. I think we've kind of covered it, but just the one key takeaway, if you take one key takeaway, is that, extremely kind of stimulative budget, will give a really good backdrop for the economy and financial markets going forward.
Great. Thank you. Roy?
I think consumer confidence will be through the roof with the budget. I can't see anything bad on the horizon except for negotiations or relationships with China. It would be the only thing that might be a blight, but no, all good. And if there was one take home from my perspective, it would be get some one-on-one tax advice from a tax consultant before June 30.
Yep, good point. Tony?
I'll mirror exactly what Roy said, and I'd also throw in there that going back to the winners in this budget were everyone, indirectly or directly. So directly, there are a lot of people that will benefit, and indirectly as well. So and this will see some positive momentum and growth in the country over the next 2 to 5 years, and it's what you do with that opportunity that'll actually make that difference.
Opportunity, and reach out to your Modoras and RJ professionals. We're here to help. In fact, there's a couple of things. We'll finish the last couple of slides. Obviously, everyone on here today is a professional person gift to you. Please feel free to reach out, phone, call, email. We will put aside some time to personalise some discussions with you, whether it be with our accounting or wealth professionals or business advisories. We're here to help, and we're very much available. So please feel free to phone, call, email, and we'll arrange a time to make sure we have those discussions. We'd also like to bring up, we might answer some more questions and put a bit more depth to what we spoke about today. We do have a couple more webinars leading into tax season, tax planning for businesses, make smart business decisions this tax time. We'll be digging a lot deeper about where the smart money goes, what are the smart businesses doing as they prepare for tax time, what are they doing when they do tax representatives across the doors and RJS. We'll share some great case studies, some great insights. Similarly, we'll do the same in our third one in June for tax planning for individuals. As like one of my opening statements, we all pay tax, we're all individuals. So how do the financially successful maximise tax time?